Edgeless Horseman here. It's March 23, 2022. This will just be a short rant about just how incredibly clueless the market is, and that this is basically the best setup I've ever seen and expect to ever see in the junior sector for the rest of my life, pretty much. I mean, as I said before, a lot of people tend to look at gold and silver, etc. As cues, basically. You want to buy juniors when gold is up or silver is up. You want to sell when they're a day that they're down. Short-term focus, and I mean, at the end of the day, gold and silver has less to do with the performance of your juniors than most people probably are aware of. I mean, it makes sense that, okay, gold and silver is up. My gold and silver juniors, the implied value goes up a bit. But at the same time, especially these growth stories. If you expect them to grow for like the next 3-4 years, it's much more. I think first of all, important to have a longer time horizon than the market, because the market prices in the short term, uh, even if even that, otherwise it's hard to explain. This is basically a sentiment indicator. The purple line is Bear Creek Mining, silver developer. Recently they tried to become a producer, so I guess I don't know how, it won't have the same use, let's say, going forward, perhaps. And you've seen, the market doesn't appear to have been too keen on that announcement. And the candlesticks pattern is strategic metals, which is basically, around these levels, it's trading for, no price put to any of their projects or their royalties. So I think that's a very good indicator of just how, when this stock is trading down here, it's pretty much, that the junior sector is brain dead cheap. And, you have these oscillations in between. But, this is enough to, like, okay, yeah, juniors are buys right now, because both, the sentiment indicators and valuations, everything is pointing to the same thing, basically, that they're no-brainer cheap. But it becomes even more apparent when you add gold, in this case GLD. And this is why I, have said a few times before that the opportunity, the risk reward in the junior sector right now is way, way better than the 2015-16 bottom. And I know a lot of people. I bought in here because they were just cheap. That's when I started buying juniors, around I think August 2015. But as you can see, gold was way down here, and you were basically paying for something. Even though the juniors were cheap in absolute terms, they were actually worthless at face value, because no project pretty much made sense. So you were, it's common sense that, okay, the gold price must go up, because otherwise the business as a whole is going to go away. And obviously that's not gonna, that wasn't going to happen. So there was, the risk were to the upside, and eventually every bear market turns into a bull market. But at face value, you were buying companies that were worthless on paper in the present moment, given where gold and silver were trading. A lot of them had very little in terms of funds, so there was a bunch of juniors that were actually near bankrupt, and near bankruptcy, and there were actually some that went bankrupt. This is a completely different situation today. Gold is not too far from all-time highs. And you have juniors, not in the absolute sense perhaps as cheap as they were during this bottom in 2015, but right now the gold sector is thriving. Juniors have no problem getting money. You see upsized private private placements all over the place, and they're pretty much almost as cheap as they were when the actual business itself was worthless and gold was trading at, $1,100. I mean, just look, when you account for this gap in like business value, and you count, you include the business value relative to the valuations, it's exponentially better than the 2015 bottom. I mean, it was hard to buy down here. I can imagine, at least. I mean, I bought hand over fist because I just thought, okay, I've never seen them this cheap, so I'm gonna make a lot of money when they turn, which I did. I mean, from the bottom, my portfolio went up 500% within 8 months or so. And I had many different juniors, and some were even pretty crappy, or I think many of them were crappy. So it wasn't even that the companies themselves did anything special. It wasn't like I was invested in high quality growth companies. They were just so absurdly low priced, and not even in absolute terms, not relative to gold even. But then like the sentiment indicator. I mean, this is basically capturing the flow of funds. Up here, there's a lot of new buyers, etc. Down here, there's almost no new buyers in the market. So this has just pretty much one way to go. I mean, if everyone is out, there's only one change in state that can happen. That's that there's more buyers, because again, most of the potential buyers, etc., they're not even in it, and most people that were gonna sell have sold. So it can only really, the delta can only really be to the upside, in a sense. I mean, you can have flash crashes like in the COVID flash crash, but that rebounded quickly. So like, I've never seen since I started in 2015 a more obvious opportunity. I don't expect to see juniors be this kind of no-brainer buys for the rest of my life. And again, just pointing out the fact that if you complained, or you have regrets of missing the previous bottoms, if you're not buying now, I mean, nothing can help you, because you'll probably never outperform the market. Because if you can spot how big of an opportunity this is, how extremely large the price to value gap is, how no-brainer, it's not even risky. That's the thing, it's not even risky. You're buying, if you have a diversified portfolio, you basically have a an option, basically not limitless, because there will be some dilution, etc. But it's so overwhelmingly the risks are to the upside. It's not even funny. And we can look at some junior charts. For example, this is line 1. I mean, obviously hasn't been following the price of gold. Why? Because we the sentiment has been going down. That's the only thing you need. So it's like pricing in juniors have gone down while the value of the juniors have gone up. And again, this looks completely different than this. It's like polar opposites. So I would say that juniors are like, I don't know, 3-4 times as good of buys as they were back and down here. And I like to look at the RSI, even though I don't actually use it. I mean, I like to buy cheap, because again, it's like, yes, if you're just trading RSI, you can actually, I think you can make good money on it. I mean, I think RSI is the most useful tool I see in terms of TA, because I'm not too keen on TA overall. But if you're a value investor, you would obviously be buying here and not, okay, it's not a big difference, but if you just buy heavy when it's cheap, I mean, that tends to end well anyway. It's like you don't need TA to know that, okay, every unit is cheap down here, cheap down here, cheap down here. Goliath Resources, same thing pretty much. I mean, I think this is one where RSI has, in hindsight, I mean, I've just held my position all the way through, and I've actually been adding lately. But I didn't add just because RSI is now giving, two buy signals, one pretty large one, and we broke out of this resistance zone. No, I bought, as low as possible because it was cheap. But I've been adding because, again, it's like if you look at this buy signal, for example, that was hundreds of percent over multiple months, and this is signaling that this is a start. And personally, Goliath is probably the best or second best real spec I've ever seen. Eloro Resources, major consolidation, and since I already think it should be valued way up here already, you might have seen, I've been pounding the table for months now, and I've been buying all the way down here, and I've been buying, I bought some yesterday as well. Okay, if obviously you can see that Eloro likes to consolidate in boxes, basically. Okay, consolidation, breakout, consolidation, big breakout, or big move, hundreds of percent, and now we're in just a even longer and one could say larger box. Obviously this is not a log scale, but okay, yes, if history repeats, which I think it will, because I think Eloro is already worth a lot more, when we break out, it's going to be to the upside, and we're going to go on a multi-month 100% rise. That's my base case, at least. And if you're a pure trader, you would obviously enter a position here, or when it backtests here, etc. But as a value investor, I ramped up my buying down here because like I said before, yes, TA is interesting to look at, etc. But it's like, I think I'm leaving way too much money on the table if I know something is, my estimation is incredibly cheap, and the lower it goes, the cheaper it gets, because I think it will be up here one day. I'm not waiting for this to break out and confirm and I'll catch a, 200% return. From these levels, that might be a 500% return or something. So it's like, I like to front run the future, and that's why I think having a longer time horizon than the market is the best way to go, again, because the market is pricing in the short term typically, especially in the junior sector. And if you look farther ahead in the market will almost always price in a growth story the wrong way. So the market will almost always be wrong. It might be wrong or kind of right in the short term, let's say. But if you look at the news releases, 5 to 10 or 20, it's not pricing in that at all. So that's how you play a different game than the market. So the market will allow you to buy the future set by short-term expectations. So that's, again, like I said before, a huge arbitrage in my opinion, and that's why I think this market is actually, it should almost be illegal to have opportunities like this. This is like risk-adjusted stealing, pretty much. And most people are out there buying owning something overvalued, a Tesla, or I have no idea, Dogecoin, which basically is worthless, and stuff like that, and hoping that what they own that might be already pretty expensive, that it will become more expensive, while one can buy the sector that's cheapest it's ever been, possibly. It's like two totally polar opposites, and the reason why this opportunity exists is because almost nobody is aware of it, obviously. So yeah, it's just, you're in the market alongside everyone else, but it's like the risk reward you're getting is completely different depending on where you look. And like Timberline Resources, again, I like to look at the future. And I think, with the recent high grade hits, etc., and how much exploration potential they have, I expect a growth trajectory like this. So, higher at least. I think I simply think timberland will be increasingly more valuable with each passing month and year, 4 years. So then I, assume that okay, then it's gonna break this major head and shoulders pattern here, reverse head and shoulders pattern. So I mean, and a trader would buy it here, let's say. But if you thought it was, you were pretty sure that it is gonna break this anyway one day, you don't really need the confirmation because you're a value investor. I mean, you would be buying here, obviously. So the returns, if this is a 120 return when it breaks here, so a trader gets a 120 return, but you might be, the value investor, since you bought low, you might be, look at a 200 to 300% return anyway. So it's like, yes, I see a lot of people typically, lambasting the fact that they, you bought here and you're sitting all the way through this. Yes, sure, but if you have high conviction and know your story, let's say, you'll be buying down here, and even if you don't have dry powder, for example, you might be, shedding some other position that hasn't gone down like this, let's say. So that way you can still, take advantage of the opportunities. I mean, I call it a bit, playing the piano, which I like to do because I'm pretty much always fully invested, and there's nothing I hate more than a wasted opportunity. I really understand the feeling of frustration when you're sitting here buying. If you don't have any dry powder, you bought here, and you're sitting just watching your portfolio go down and the opportunity getting better and better and better, and you have no way to act on it. That's the most frustrating thing I know. So I mean, one way that I combat that, I guess, is that, if you have 30 stocks you like, let's say, some will go down more than others and the opportunity will get better than others, and some, companies where the stories change for the better, and I mean, if you have a identical price chart for a company that's gone down like this, but that story has actually gotten even better, I mean, then there's, risk-adjusted, risk-reward arbitrage, just simply shedding shares from one position to the one where actually intrinsic value got hiked up, while price trended down as same as the stock you own. So I mean, at face value, you're selling something that's down 30%, buying something that's down 30%. So you're like, yeah, you didn't create any more wealth at the present moment, obviously, but your future returns will get boosted. So that's why I think there's certainly a way to boost your returns, even if you are pretty much all in. It's just that you have to be a bit more active. And honestly, I don't think you really need it. It's like, I wouldn't. I think it's a waste of time. Well, not perhaps waste of time, depending on how good you are, let's say. But it's like, I see no reason why one needs to, be a perfectionist and try to day trade, every swing, every short-term swing, for example. I mean, this is a profound gap. So I mean, yes, you might be, if you played it better than, if you were trading it well, let's say, you might be sitting on 300% returns, let's say, when sentiment levels get up here, and otherwise you will be sitting at 200%. I mean, it's still great returns, and I mean, in my opinion, the just worst mistake you can do, from my perspective, is selling. I mean, that's the costliest thing, because you're obviously, I mean, every time it hits this level, you're looking at 100% returns within not the too distant future, like 1-2 years, etc. So when you're selling, you're giving that away, obviously, to someone else who bought off of you, assuming said person can actually hold out. So this is, I mean, this is just buy. I mean, my strategy is buy as much as I can when it's super cheap, and then just wait. And that alone is pretty much enough to have very good returns, because it's hard for people to buy low in the first place, because I mean, I still, well, not as much lately because the juniors have been going up a bit, But just around here, a month or a few months ago, I mean, people were basically, airing their thought that, well, they can go lower. Of course, they can go lower. But that's not the point. The point is that they will go a lot higher. So it's like if you bought here and sat through here, that was not a mistake. Juniors are gonna go up here one day. Even if you buy here, you're gonna be in profit. Even if you bought here, but most people obviously they come in late. Let's say they buy here when they see a clear uptrend. The water is warm, come right in, and then they come in late. Then the sentiment turns, and then they sell down here perhaps, and then they see it go up again. It's like, okay, now the real move begins, and they buy here, and then they sell down here and say to themselves, well, it can go lower because you've seen it 2 times before already, and then they sell out. I mean, there's nothing wrong in just like myself. I mean, I've been long. I've been on along for the ups and downs, but I just ramp up my buying when it is at cheap levels. And then preferably you have a case like Goliath, for example, where the bottoms tend to be higher. So I mean, this is Bear Creek Mining and Strategic Metals more trading like a trading sardine, where the third bottom is as low as the first bottom. But if you look at growth cases, for example, their bottoms tend to be higher. So you get paid to wait in those. So it's like if you combine these two factors, in my opinion, play growth and really be keenly aware of sentiment. I mean, you shouldn't really need this. I mean, you shouldn't really be aware that what the sentiment is saying when you see like ELO putting out monster holes, etc., and you see price go down. I mean, you wouldn't need confirmation. You shouldn't need confirmations that yes, the junior sector is at a sentiment low, so it makes sense that ELO is at a low. That should be instinctive buying, simply because you're aware of the specific price to value gap in that junior. But it sure is comforting to look at, and it's like, yes, okay, this sentiment map confirms the fact that juniors are dirt cheap. So it's not like most people are afraid. The market knows something. The market knows something. That's why it's going down. And I used to be that as well, I think. But when you realize, it's like, I think, when was this? Just prior to 2022. Okay, it wasn't exact, but I mean, these ELO and like Goliath bottom around the same time, and they have nothing in common except they both have silver basically. So there's no reason for it, but this explains it. This was around this bottom, and Bear Creek Mining is actually down here. So it's like the way to wrap it up: have a longer time horizon than the market, and it becomes a lot easier to allow yourself to beat the market if you understand the market. It's like the saying with poker: if you can't spot the fish, then you are the fish. So when you get comfortable in knowing that sentiment drives this junior sector so much, then then you can look at a growth downtrend, for example, and just yeah, okay, this is just the market being extremely stupid, like it tends to become, and then that's gonna change. It's not that the market knows something, that, oh, Iska just got worse here. It's worse here than it was here, whatever. No, it's just flow of funds. It's just sentiment doing its thing. And again, right now we're at the most no-brainer opportunity. Low sentiment, valuations very low, price of what you're or value of what you're buying pretty much never been higher. So yeah, this was just gonna be a rant basically, that if you can't spot the opportunity right now in the juniors, then you have a lot of work to do with how you approach the market. And you have a lot of work to do in figuring out and be comfortable just how much sentiment plays a part. And again, if you worship Mr. Market, if you think the market is always right, then you won't dare to trust your own conclusions. That, like, I think Elora's extremely cheap down here. And actually, it's I mean, a good example is, okay, this is when we started hitting in Porco. So maybe Lure was, worth around this much, or implied value was up here, let's say, when I was buying down here. So I thought, yes, this is cheap because I think it's worth around this much, and it's gonna can still grow beyond that as more de-risking happens. But then we had the Porco results, and I mean, given how large Porco is, the Porco target and the Porphyry target is, and how good the results were, like the two best holes or something that have been drilled on Iskiska. So I think actually let's say the implied value jumped up here. So it's actually, I think, a better buy here than it was here. But you still see, people typically ask, did I miss the train? And that just tells me that they don't really know what they're buying. They're just looking at the chart. And I talked with quite a few people who they're unwilling to buy a growing junior, let's say, a short that's going up because it's, I missed the boat. It's like, no, I mean, in Elora, I don't think we've even started yet. Given how, large this system is. I mean, this is still a peanut valuation. I mean, Blue Sky potential is easily, in my opinion, a 10 bagger from here. So it's like, no, you didn't miss anything. I mean, I own a lot more shares of Eloro and Cartier Iron, which Cartier Iron owns shares of Eloro. I own a lot more here than I owned back here, let's say. So I think the opportunity in Eloro is a lot better here than here, and it's a lot better here than here. But if you're just looking at price to be, I don't know how they think, but well, I can understand. It's like you just look at price. So the share price is lower, so the opportunity must have been better or whatever. And that's not how it works. That's not. Then you're not even factoring in that there is a price value gap. Then you think the market is always right. And I mean, first of all, I mean, we didn't know Porco was gonna deliver these kind of results. So this was like, here you actually took more risks on Porco, obviously, but I think the value of the de-risking that happened in the two holes and confirmation pretty much of the mag anomaly, de-risked it so much that I don't think it has even priced in, well, not even close to pricing in the potential of Porco. So just don't look at the opportunity is at any given point, given every information you have, and that involves both price and expected value. So like now, like with opportunity cost, opportunity and opportunity cost is in the present moment. The opportunity is good here because you have this big gap, and sentiment is this low. The opportunity is not here when in hindsight you should have bought. I mean, you first do the right decision. I mean, this is a killer buy in my opinion in juniors right now, because it will go up here. So again, it's like the let's say genius decision starts when you're buying or selling. Then it just takes time for it to play out. But if you knew this was a great buy, let's say, but you didn't act on it, and then it heads up here, that just means you lost the opportunity, obviously. And when it goes up here, people are gonna look back and say, yeah, there's been a lot of opportunity cost, lately, because juniors have been doing well over the last X months or so. Now the opportunity cost was probably the highest down here, and it just gets, the opportunity cost decreases as price goes up. Opportunity cost is not looking in short-term rear view mirror and saying yes, opportunity cost is high if you're not in juniors. No, the opportunity cost is actually decreasing, and the future and hindsight investing doesn't say anything about opportunity cost. Because let's say up here, for whatever reason, let's say gold goes down here and juniors go up here, then the opportunity cost here, even though there's quite a way left for sentiment to get really overbought, it might be a lot worse than well, how do I put this? Yeah, I don't know how to put this, but pretty much the opportunity and opportunity cost is at any given moment. There's an opportunity and opportunity cost right here. And whatever happens after this doesn't have anything to do with how the opportunity is right now. So if it goes down here or goes up here for whatever reason, we can't know that here. So it doesn't say that if it goes down, it doesn't say that this didn't have high opportunity cost and wasn't a great opportunity. So the results don't necessarily say anything about the past, because you didn't know that then anyway. So all we can do is try to make the absolutely best risk-reward decision we can with all the information we have at any given time. And then it's like, up for the future to show what happens. But again, it's like same thing if you buy a junior because you're excited about a drill target or assay results, etc. If they're very good, the results, and the stock goes up, you'll typically conclude that yeah, you made a good decision buying before it. And if it goes down, you'll conclude that yeah, it was wrong of you to buy. No, that doesn't have anything to do with it really. I mean, because you don't know that information beforehand. So I mean, you might be buying a overvalued explorer that overvalued drill spec. Let's say Garibaldi, for example. Okay, you're buying it at 400 million in 2017 because you think they're gonna have the next Norilsk. And let's say they have one of the best, absolutely best intercepts you've ever seen, and then it doubles and goes up to 800. I think that was a bad buy, regardless, because you were paying 400 million for something that was not proven in the slightest. I mean, they didn't really have a discovery hole, not a single discovery hole. So it will always be a bad buy in my book, regardless of what happens afterwards. And if you buy something, let's say something is trading for $2 million and it has one of the best early stage targets out there, and they miss and it still goes down 50% to 1 million, I would still say that that's probably a no-brainer buy, simply due to risk reward, because if they hit, it might go up 500,000% in a day, theoretically. So it's like the results don't necessarily say anything about how good your decision was, because we have no idea. Nobody can predict the future. And again, the best thing we can do is contemplate the risk reward at any given time, which is right now, based on everything we know, and try to have a guesstimation of what the risk reward is if it's a buy or a sell. And it's only in hindsight, for doing this repeatedly over like 10 years, you'll know if you've been good at it. That's why short-term portfolio returns means nothing. I mean, there's people with Dogecoin that are up 3,000% or were up 3,000%, and your portfolio might take decades to have that kind of, or years at least, to have that kind of return. But that doesn't mean that it was good to go all in Dogecoin. And when that ride is over, they probably have no way of actually having good long-term results. So it's all about the process and strategy. Something that can be repeatable is good. if it's a good strategy, and you will only know or have an idea of how good your strategy is in the long term when you made countless of decisions and you see the long-term chart. Otherwise, you can just be lucky for let's say you buy 3 overvalued explorers in a row. Everyone exceeds expectations. They go up, and you started thinking like, yeah, I'm great at this because my 1 to 2 year results are great. So basically, you were in this scenario, you were making poor decisions based on risk reward, got lucky, and now your returns have been great for the 1 to 2 year period. But then when you are starting to get unlucky, coupled with making said bad decisions, you'll destroy yourself in a hurry. So it's just after a long time period, we'll know if we've on balance made better or worse risk reward decisions, and we don't know that beforehand. So it's like the main thing is to do the most rational, common sense decision we can right now. And also, if you have a long-term case for a company, if you traded based on the short term, then you just wasted your edge. I mean, like SK Mining, for example. I mean, I think that looks incredibly good on a long-term basis. I think it will be worth more 1 year, 2 year, 3 years from now. But if that's my case and it's cheap in that scenario, I mean, if I start trading it short term, guessing where the, betting on what the next news release is gonna do, then there's no profit for me of having a solid long term case, because I'm not acting on it. I'm acting on short term horizons. So you waste that arbitrage of buying the long term for pricing in the short term if you're actually also instead of letting the case play out, you actually also buy and sell based on the short term. So it's like neglected the fact, it's negated the fact that there is a long term case. So you have to be aware of what your case is about and what the obvious strategy would be in that case for said long-term case, and you will have periods where you look wrong and where you look really right, but if you just keep having a rolling 12 to 24 month basis on your cases, I think you're gonna do fine. Consider me biased. I own shares. I own shares of all companies I mentioned. I think everyone is a banner sponsor as well. And do your own due diligence. Always know what you're doing. You can't adopt anyone else's conviction, etc. And juniors are risky and volatile. Thanks for listening.